Hello and welcome to a special edition of The Global View. And let me now welcome on board Jim Walker, Chief Economist at Alethea Capital. His expertise in Asian markets, global macro forecasting and his prescient 2008 crisis call clearly has been quite clarion. And one would love to get insights on what the US stagflation, if at all, could mean trade, emerging economies, and how is it that we should be reading into the world right now. Jim, hi, welcome to ET Now once again. And I want to talk to you about Fed's 25 basis points rate cut last night, driven by a cooling labor market, aligned with your stagflation concerns earlier that you've talked about in your report as well. Do you view the rate cut primarily, Jim, as a tool for risk management by the Fed, or do you think it will also shore up the economy?
Well, it wouldn't make that much difference to the economy, to be quite honest. And it's really a slightly bizarre reading on rate cuts because the Fed came out and said after it that it was relying on the data, but only relying on the data from the labour market. And of course, as we now know, given the big revisions to the labour market data that were announced a couple of weeks ago, that data is really pretty poor. And yet we've got data from the price market, consumer prices, which is not suspect and certainly not that bad. And it really wouldn't be suggesting that they should be cutting interest rates at all. Inflation is still high in the US. It's way above the 2% target. It has been for years now. And although I think stagflation is a pretty clear choice, a clear chance of happening over the course of the next 1 to 2 years, I think that rate cut is really kind of looking at the wrong things. And the Fed and the government need to be looking at government spending and the inflation numbers.
Sure. So, Jim, with the Fed now projecting 2 additional rate cuts in 2025, how might this easing cycle impact Asia's export-driven economies, particularly under the shadow of the US tariff policies that you flagged as a growth headwind?
Yeah, I mean, it's all a mess, Aisha. That's the big problem, that you can potentially get good news for the emerging markets in Asia, and in terms of the debt, the foreign debt that companies and governments here have. If the Fed's cutting interest rates, that's quite positive. At the same time, of course, what's happened over the course of the last 9 months, basically since Donald Trump came into office, is that the dollar has weakened. And I think it will weaken a lot further from here, by the way. But that's also good news for emerging markets. But at the same time, you've got the tariffs coming on, which is bad news. And we've got the growth outlook for the US, in my view, weakening. Obviously, the Fed yesterday said that it was slightly increasing its forecast to 1.8% for the US next year, which actually is a slowdown from this year. So I'm not sure that that's a positive. But it's all really, as I say, a kind of mess that we've got out there, and trying to navigate this is extremely hard work. So I've tended to rely on fundamentals in countries that we can see fairly clearly that policy is going in the right direction, that corporate earnings are there, and that there's prospects of good growth and recovery. So you really just got to stick to your knitting on this one and look at the countries individually and forget to a large extent the noise that's going on globally, because if you don't, you're just in trouble.
But Jim, tell me, and reflecting on your very accurate 2008 crisis prediction for the world, what parallels do you see between today's Fed, or rather last night's Fed response to the labor market signals and pre-crisis conditions? And how do you think then should economies in Asia be bracing for a US or rather potential US economic spillover?
Yeah, I mean, 2008 was actually quite easy. The housing market in the US had become a giant problem for them. It had, as a percentage of GDP, increased dramatically in the period 2001 to 2006. So forecasting that problem becoming a financial problem wasn't that difficult. This time round, it's a lot less clear in terms of finding a sector that would potentially collapse in on itself and then bring the financial system down. Because the real problem in the US now, and it's not just a US problem, it's a problem, I'm afraid, of the advanced economies generally, is the government and the way that government has been acting over the last, well, number of years, in particular since 2008 with the ultra easy monetary policy, which has stoked inflation in those countries, at the same time as governments just won't stop spending. And that also stokes inflation. So the real issue here is what can governments do, what can policymakers do to put the genie back in the bottle? And the problem is that being politicians, they don't want the genie to go back in the bottle. They don't want to cut spending. They want to keep printing money. And with that, then you have this stagflation scenario unfolding. And unfortunately, stagflation is a very nasty outcome for the global economy and for the advanced economies, but much bigger problems for the advanced economies because they've been the ones that have been creating the mess. Emerging markets, which have actually run policy reasonably well over the course of the last decade and a half, should be much, much more resilient, which is one good thing, although they'll feel the downdraft of pessimism coming from investors in the Western world, the advanced economies.
Interesting. So you've called, Jim, interest rate forecasting akin to spinning a roulette wheel. I know that. But post last night's cut, what surprises in the Fed's dot plot or Powell's remarks could reshape your outlook for global markets for the year ahead?
Well, the one thing that was no surprise was there was one member of the FOMC right at the bottom of the dot plot, which is the new appointment by the president to the FOMC governor's position, Stephen Miran. He wanted a 50 basis point cut, and clearly going forward, he's looking for interest rates to fall much more sharply than everybody else. But what I found very interesting about the dot plot yesterday was that going into the next Fed meeting, there were 6 members of the FOMC, the committee, who expected no interest rate cut at all for the rest of the year. Now, the interesting thing about that is that 6 members is almost half of that committee. So only another 2 or 3 need to move into the group that are saying we've still got an inflation problem, and markets will be hugely disappointed by interest rates not being cut at all. But as you quite rightly say, at the moment, forecasting the interest rate outlook is like spinning a roulette wheel because it changes from week to week. Now, my view is that the US economy is softening, and I think that given everything that's happened this year, including the tariff mess, it will be going into recession during 2026, and that would be real justification for interest rate cuts. But at the same time, the inflation outlook remains elevated. And if that's the case, we might get into a position where, which is now the UK, which has cut interest rates 5 times in the course of the last year, and the 10-year bond yield in the UK has gone up. It hasn't come down. And that's a big danger for the United States, I think, in 2026. The dot plot might not matter anymore because the bond markets don't like what governments are doing.
So, Jim, too many factors at play in the world right now. But how might the Fed's cautious easing alongside geopolitical tensions affect economies like China, for instance, and their growth trajectory in the next 12 to 18 months, especially with volatile commodity prices too?
Yeah, I mean, China's a very good example. So, as everybody knows, China's economy has had challenges over the course of the last few years, many of which have been brought on by their own policy making because they were trying to address a housing sector problem, the fact that the property market was just too big and was driving the economy and driving a lot of asset shifting in the economy. But they've addressed that problem, and as we know, the economy has slowed down. So the challenge for China coming into this year was, what do we do about it? How do we effect change in the economy that would revive it, and especially given some of the threats from the Trump tariff policy. But if you look carefully at what's been happening in China this year, there's not much been happening. And the way we've described it is that China this year is in a holding pattern, because there's no point in huge stimulation going into the economy if, for example, the Trump tariffs didn't take place and then the export market was fine, and all of a sudden you were in an overheating situation. But I think by the end of this year, there will be much more clarity about tariffs and about some of the impact of tariffs on global trade, etc., etc. And the Chinese will have a much clearer picture of what they have to do to stimulate the economy. And they've got plenty of scope to stimulate the economy. So I think next year is going to be a much better year for Chinese economic growth. The competition that they've got going on in certain sectors of the Chinese economy, electric vehicles, batteries, solar panels, some of the technology sectors, which has forced huge competition in China and price cutting in order to try and get some people out of the market, some of the loose holders, the poorer companies, trying to make them fail. That will work. And when consolidation takes place, then profitability will recover, and so will investment. So the outlook for China in 2026, I think, is really rather good. And it might well be that the stock market improvements this year are actually just a reflection of the future. Things are going to get better in China, regardless of what's happening in the United States.
So, Jim, if I were to ask you to draw in from your experience, what would be the three factors in the next 12 months that investors should consider to invest across geographies, anywhere in the world, and across asset classes as well?
Okay, so obviously I would be focused on the stock markets that we as a company have recommended to our clients to be long in or to be short in. So the two countries that we have global strategy longs on at the moment, which are significant countries in the emerging market universe, are now China, which has been introduced very recently, and India, which has been there for a long time. Now, India is the one that I think is the most interesting. I don't mean it's going to do better than China, but I think it's most interesting in terms of where it finds itself in the cycle. Because, as you know, India's been doing well for the last number of years. It's very difficult to get economic policy any better than has happened in India from the fiscal side and from the monetary side since the COVID crisis. But there is one big challenge for India that lies ahead now, and that's to improve the business environment within the country. And the funny thing is that I think Donald Trump might just be helping India make some challenging decisions on cutting red tape in the economy and increasing the ability of businesses to do things much more easily. So we've now had the GST changes, which reduced the number of GST bands from 4 to 2. That's simplification. That's positive for business. I think some of the changes in the areas that have been where there's reduced GST are very positive for consumption moves over the course of the next year. The next step will be to improve some of the laws in India that make it difficult for companies to increase their employment levels and do business easily. And I think the tariff war between India and America could actually be used as a good lever to get change into the Indian economy. So I remain very positive about India, but what I'm looking for is changes on the tax front, changes on some of the legislation front to make business easier. China, as I've mentioned, I think we just wait and see what's going to happen next year. They'll have a much more focused view of things. And remember, Xi Jinping is coming up for reappointment in 2 years' time, that's not a done deal in China. Everybody seems to think that he's there for life. That's not at all the case in China. He has to deliver the goods. And at the moment, he's not delivering them in terms of wealth and confidence in the economy. So things are going to change in China next year. Policy is going to change, and you're going to see much more effort to get the economy moving. So these are the kinds of things that I'm watching for. These are two of the countries that I'm most keen on. And I think everybody in the world should be investing more in India and China.
But you know, I want to talk a little bit more about India, Jim, because right now India is being looked as a tactical versus China kind of trade. And you are seeing a fair amount of FPI and FI money withdraw out of India and perhaps plow into markets like China. What would make them come back in the very near term?
Well, of course, the reason that there's been that kind of movement in India is because so many people talk about the overvaluation, the market's expensive. And bear in mind, India has done well for the last few years, both in terms of market returns and in profitability. So there's some suspicion that good period is coming to an end. My view is that if I'm right on changes in the bureaucracy, the way that red tape is handled in India, simplification of processes, making it much easier to do business. I think we're just at the start of another phase of significant economic activity in India. So I think they're getting that wrong quite badly, and I'm quite happy because it means I can put money into India, my own money, at a cheaper price than would otherwise be the case. But as far as moving money from India into China is concerned, I actually think there's been very, very little of that. There hasn't been much redirection of funds into the China story. American fund managers are still very much driven by the politics in the United States, which remain anti-China. I don't think India needs to worry about losing that much money to China, especially from the stock market. As regards foreign direct investment, that's always a patchy flow anyway. When I was speaking to some companies earlier in the year, when there was even more fog about the tariff impact and where they were going, it was before the Liberation Day announcements, but after the first phase of we're going to set tariffs on everybody. What those companies were saying to me at that time was that they had basically suspended all of their investment activity. So especially in non-home countries. So I think foreign direct investment flows have not just fallen in India. I think they've fallen more or less across the board in emerging markets, purely because people are waiting to see the impact of the tariffs and where those countries come out in terms of the tariff war. So next year we'll have much more clarity on that again, and then we can make an assessment of whether FDI is flowing out or not going into specific countries for whatever reasons. But I wouldn't worry about it too much this year. I think it's just been uncertainty that has driven a lot of investment decisions, or in other words, no investment decisions.
Jim, if I were to ask you as an India investor that I want to cut all the noise out, I want you to build me an India-only portfolio and no compulsions of market capitalization, what would be the color of the portfolio or the sectoral allocation that you like within India right now?
Well, you know, I'm not a stock analyst.
No, which is why I asked you sectors.
Yes, we're quite late in the cycle now in India in terms of a business cycle. And the funny thing is that the best performing sectors in the late stages of business cycles are usually banks, financials generally, and the consumer, and consumer stocks generally. So if it was me that was picking the portfolio, that's what I would be looking for. But as I say, bear in mind, I know nothing about the companies, so I'd be employing a fund manager to help me in that search. But financials and consumer stocks in this stage of the Indian cycle should do best. The capital cycle, the capital goods companies, the investment goods companies, and to a large extent the construction and infrastructure plays, they, in my view, would probably be the laggards in the next couple of years.
That's quite interesting, Jim. Always lovely chatting with you. Thank you so much for your insight and thoughts.
Great. Thanks, Aisha.
Thanks.